utilities and telecom and even staples in some instances is close to multiple standard deviations above their long-term average. So are there places in the market where you can find dividend growth at a reasonable valuation? For this discussion, we're joined by Chris Raper, Senior Vice President and Portfolio Manager at Chris Raper and Associates of Raymond James. Chris, thanks so much for joining us. Let's first talk about this run-up that we've seen in some of those sectors and where you stand on it. Do the valuations make sense to you?
The valuations are extremely expensive from a price-earnings multiple. When you look back in history, especially the last 30, 40 years, we're at record levels or near record levels. The valuation makes much more sense when you start comparing it to current interest rates. And in this low to negative rate environment, you can make an easy case for a lot of good stocks are still representing great value here.
So does that mean you're still buying in some of those sectors like utilities and telecom?
Utilities and telecom are growth challenged in our mind. And for us, it's about rent checks that can grow. Rent checks being our moniker for dividends.
Why don't you go through some of the specific names that you've been watching, and maybe that helps to sort of shed a little bit light on how you go about finding these names?
Sure. CCL Industries, a great Canadian story, specialty packaging company, literally all over the world. They've got plants in every continent except Antarctica, logically. Great management, probably some of the best we've seen. And, the yield on it is not much at current price, a little less than 1%. But when you understand that they've managed to grow that dividend at about 30% per year for the last 3 years, you might see that stock in a different light.
Just to follow up on that, I mean, I think it's sometimes a little tricky. A lot of people will just look at what is the current dividend yield on a stock to make a determination on whether this is a good dividend stock for me or not. But in this case, to your point, the headline dividend yield is maybe a little bit deceiving. So what's kind of the strategy for the average investor in terms of finding some of these ones that have a history of boosting up their dividend payments?
You really have to drill down into the company and understand what you're buying. As we've seen in the commodity cycle, you can be offered high yields, but sometimes those yields disappear. And when they do, the stock falls like a rock. So understanding what you're buying, for us, we spend an inordinate amount of time studying culture and defensive moat. Can the company compete in this slow to no growth world? And can they grow in this world?
What about a company like CubeSmart, which I believe is also on your list? It plays in the self-storage REIT space, also one that's trading at about 24 times, and the yield is less than 3%. So as we're looking for yield and low valuations, this seems to be the opposite.
At first glance, that's exactly what you would think. But when you understand that 3% or almost 3% has grown at 24% over the last 3 years, and that's compounded annually, you'll see that in a different light. Obviously, rule of 72 means that should double in another 3 years. And compared to 1% on a 10-year Government of Canada bond, that's pretty good.
Let's talk also about retail. I know you've been keeping an eye on TJX. A lot of people have been focusing on the U.S. retailers and their general struggles with disruption and how people shop today, especially the Amazon effect. That stock has been red hot. And on the dividend yield side, what do you think about a name like that?
TJX is just one great company. It's extremely well managed. What I love about it is that the executive right down to the buyer chain have a lot of autonomy. So when they see a bargain on off-price retail, they just buy that inventory. They don't call head office. And consequently, they get great pricing, and they get that through their Winners and HomeSense and Marshall stores here in Canada, TJ Maxx in the States. And that has just enabled them to consistently grow their dividend in excess of 20% per year over the last 3 years. So just another great name, really taking advantage of that secular decline in department store sales and enabling them to buy the inventories cheap, resell it at a decent margin, and get a lot of growth in the meantime, and consequently grow that rent check.
The rent check, I know that's very important to you. I just want to put everything that you've given us together, because it seems like while the valuations are high on some of these names, you are paying for them expecting the dividend yield to start to tick up, or at the very least for there to be some dividend growth. Is the takeaway here that if you are going to pay up for these sectors, at least make sure you're not just looking at the yield, but you're looking at the growth trajectory?
You absolutely have to look at the growth trajectory. We are in a slow to no growth world, and stocks that can grow in virtually this kind of environment or any kind of environment are going to trade at a premium. That's where the milk and honey is, as far as we're concerned.
All right, we'll leave it there. Chris, thanks so much for joining us.
Thank you, Amber. Thank you, John.
It's Chris Raper, Senior Vice President of
Very
Portfolio
good.
Manager at Chris Raper
Solid.
Associates.
That was actually really